In this session, we are going to see a brief overview of what is a financial option, and we are going to develop what we can do with Python for analyzing financial options in next sessions. So first of all, the definition. Financial option is a contract that is traded at a price that is called the premium, and that gives the right to the buyer of it to buy or sell. These are two different types of options. Call for the right of buying an underlying, that it can be a security or any other financial asset, and put that it gives to the buyer the right of selling the same financial asset at an agreed price. So the strike is going to be the price at which, in case the buyer wants, can buy or sell depending on he has a call or a put, and during a period of time or in a specific future date. So these are going to be limited by time, the contract. So we need to know the expiration date so that we can know the period in what we can exercise this right. If we are talking about an American option style, we can exercise, if we are the buyer, we can exercise this option as whatever time before the expiration date. While if we are using an option style European, we cannot exercise this option, either a call or a put, until the exercise date. Normally, American option styles are used for stocks and European ones for indexes. So here we have definition of all these parameters, and you are going to have a copy of these documents, so you are going to be able to have a look in detail. So let's now talk about the profit and loss at expiration. We are going to suppose that we are working with an European call in this case, so we only can exercise it at the expiration date. What would be the payoff at the expiration date? It could be the maximum of these two values. If the underlying price at the expiration date is higher than the strike, that the price agreed in the contract, in the option contract, then we would get this payoff, because normally the buyer would exercise and get the underlying at this price at the strike that is lower than the price at the market. So if the buyer immediately after exercising this option contract sells this stock or this underlying in the market, he will make a profit. While if the underlying price at expiration is lower than the strike, it wouldn't make sense for the buyer to exercise it, because he can buy cheaper this stock in the market. The underlying price is lower than the strike. But we have to take into account also the premium. The buyer has paid the premium when he bought the option, so we should remove this premium value to get the profit. We are not taking into account the commission, that it is another cost we should take into account, and it would lower the profit for the buyer. But normally commissions are not very high comparing to the premium or to what we can get with this option. So let's make an example, making a small program in Python that would calculate based in these parameters and with this example what would be the profit at the expiration date. I leave it for you to do it, and we will see it in next session.